This video is brought to you by SoundMoneyCampaign.com. Be part of the solution. Visit SoundMoneyCampaign.com today. Hey everyone, this is Elijah Johnson with FinanceAndLiberty.com, and with us today is David Morgan from TheMorganReport.com and SilverInvestor.com. Thank you so much for joining us today, David.
My pleasure.
All right, so since I don't think we've had you on this year, what is your take on the action in the silver market this year? We've taken a lot of a beating, but we're making back a little bit of the losses. What is your take on this?
Well, I stated at the beginning of the year that my take on the financial markets, and this applies to silver as well, as it's a transition year. When I made that statement, I didn't, know that we would be seeing, silver below 20. We had held at 26 for quite some time, and I actually thought that it would hold. Nonetheless, it did breach that area, and gold fell off as well, about the 1550 level. But the transition year for two reasons. One, that this will test not only the intermediate term low, but it will also test the patience of what I would consider to be long-term investors, or even the metals heads, which would include the gold and silver bugs. So that's part of the transition. But the more important, bigger picture transition is a transition of thinking of another perhaps 0.5 to 1% of the population. That transitions their thinking from the normalcy bias that everything is okay. Our rulers, I'll call them rulers because that's what they've turned into, know what they're doing, and that things can recover back to where they were, say, in the 2000s, the 2005 or whatever. And they will have a realization by the end of this year, and this is taking place as we speak, that no, the financial crisis of 2008 was the real deal, and no matter what the powers that be try to implement, it's not working, and things will never return to that status in probably their lifetimes. I'm speaking, primarily for the baby boomers of my age group. So that, I think, is a big transition, because when that starts to hit more and more people, they will start to take matters into their own hands. They'll start to ask the question, why is this happening, or why isn't this QE working? And then they will start to move into the asset class that we both know is the only asset class outside of the financial system. And that means there's no counterparty risk, and that's physical gold and silver that you actually can touch. So even though it is an extremely small market, that works to our advantage from the aspect that doesn't take a whole lot more people to catch on to the facts, the truth, the reality of what's happening, and wants to participate by buying physical metal that will basically take this market to higher paper prices.
Do you think we've hit a bottom? I know a couple weeks ago I had met you at the Liberty Mastermind Symposium. It was great meeting you, and around that time, silver was actually in the $18 range. Do you think it'll fall below that?
I don't. I've put out to my paid membership a recent video. I have about 3 services: the basic, which is just the newsletter, the basic plus, where I do videos on Camtasia and other things, and the videos that we do like at the Liberty Mastermind and other venues, I put them on our members only website, so they can basically sit at home and watch me travel around the world. Now, of course, I'm not allowed to film all the things that I do. Some promoters will let you, some won't. Back on point, I did a video update. We had on the 28th of last month what's called a key reversal in silver. And key reversals are called key reversals for a reason. Do they work 100% of the time? No, they do not. But they are a high probability. All technical analysis, by the way, is high probability. I've had some, I guess, consider them either young or undereducated people that are, paid members that are quite upset with me that I cannot call the exact bottom and the exact top every time using technical analysis. And well, the reality is it's probability, it's a tool, it helps, it's significant, yet it's not a cure-all. In other words, if anyone on the planet could call a top and a bottom every time, then obviously there would be a lot of people that would be in retirement by age 21. I mean, it wouldn't take much of a startup capital to trade yourself into a massive fortune. So anyway, back again on to the point. The key reversal took place. We've tested it briefly twice. It's held. I really think the bottom is in, but knowing commodities like I do, and especially the silver market, it wouldn't surprise me to test that level one more time, say a few months out. But I would say, don't bet on that. The stocks are starting to show some life again. Silver was up over a dollar yesterday. We're doing the interview today, and as we're speaking, it's off about 20 cents. So it's holding most of the gains. Silver outperformed gold about a 5% gain yesterday. Gold's up over 3. I like to see about a 2-to-1, and I say about. So in other words, if gold was up, say 3%, I like to see silver up about 6. But that's sort of a rule of thumb I've seen over the years. But everything said and done, I do think the bottom is in, and I think for people that are waiting for, these prognosticators that say, gold's going to 1,000 or silver's going back to 5 or all these ridiculous things that you hear out there, they should start using some logic and say, I don't know, David Morgan doesn't know, no one knows, but it was below 20, now it's above 20. I haven't started. I better start here and have a plan. And the best plan for most people is to instill discipline, and that is to buy on a cost average basis, meaning you will put in $50 a month every month, no matter what the price is, and continue to buy. And that will average you in at the best average price as long as you're in a bull market. I believe strongly we're still in a bull market.
So going to the end of the year, you mentioned that silver might retest its lows, but where do you see silver at the end of the year?
Yeah. Let me just restate that. Correct. You got it right. I think, the seasonality is for gold to hit a bottom in August. But the seasonalities really haven't worked very well the last couple of years. But by the end of the year, I think we'll see silver back at the 26 and go back to the 1550 level. And this is the breakdown level. This is the support level that held for quite some time for gold, held quite some time for silver, and it breached those levels. And I, again, in my members, put out a video stating a few days ahead that this was going to happen. It was obvious from the technical situation that this thing was going to break down, break through, and really be bad. I had a consultation with a pretty large hedge fund manager who says, oh man, if it goes below 26, I am dead, and we talked about some strategies. I put him in touch with my broker and he basically saved his situation because he bought a massive amount of puts to hedge. Hedging is when you protect the exact position you have. So if you have a $10 position or a $100,000 position or a $5 million position, doesn't matter. You hedge what you have at risk and not more. If you hedge more than you have, then you're speculating. And I'm not against that. I'm just saying a hedge is a hedge. So he hedged and, of course, was very happy because it went, as you know, from the 26 level down to the 20s and below. So that was useful. I'm not going to apologize to my members. I did it before it happened. I wish I'd maybe done it, a couple of weeks before it happened, but the technical indicators weren't that strong at the time, so I did the best I could. So it does pay to pay attention, and especially now. Again, people that have bought higher, they might want to consider averaging down. People that are waiting on the sidelines, there's no better time to start than right now.
So I know at the Liberty Mastermind Symposium, you mentioned that silver is the Achilles heel of the financial system. Did you want to expand on that and explain a little bit what you mean by that?
Well, first of all, yes, I will. But first, let me just state that there's a video out there on my YouTube channel, which is Silver Guru. And if you type in silver, the Achilles heel, it'll probably bring that video up. And it goes through why I think it is. Several reasons. I started that video by stating that the old adage that the golden rule, meaning that he who owns the gold makes the rules, regardless of all the swaps, manipulation, and everything that's going on in the metals markets, the gold market is half owned by central banks and bullion banks. They have the claims on it. So gold is still really fairly mainstream, believe it or not. I mean, banks own it, they loan it, they lease it, and they do, in most cases, consider it to be a financial asset. They leverage it quite considerably, and the derivatives market in gold could be considered to be roughly 100 to 1. Silver, on the other hand, really doesn't have any central bank or that considers it to be money. Although what's interesting is it's leveraged almost exactly at the same rate as gold. So from the financial objectives of derivatives, it is considered money. There's only 3 things that are leveraged at that exact proportion, and that's gold, silver, and currency markets. So we see silver as being the poor man's gold has been referred to, and it's dispersed much more widely because a lot of small investors buy it and continue to buy it. And it is a financial asset as well as an industrial commodity. But this is an area that I think that they would have the most trouble getting out of a situation where there wasn't enough physical to cover. Gold, I think there's probably enough around. Although, as I'm saying this, the gold market is extremely tight. This Dutch bank that was holding physical told their clients they had to settle in cash. Germany's asked for its gold back, and the New York Fed said, no problem, give us 7 years. So a lot's going on the gold side as well. In fact, at this point in time, it looks like gold is probably more difficult to settle in physical than silver is. Either way, I think silver has a little more potential because, again, it is not held by banks anywhere. The people can afford it, and as things unravel further, I think they'll be drawn to silver more than gold just from the aspect that the price differential is so great. So if gold gets back up to the $2,000 level, a lot of families will say, I can't afford an ounce of gold. It's $2,000, but silver is only, I'd pick a number, 40 or 50 or something. Certainly I can afford that. And that's what happened in the late 1970s. A lot of people that caught on to what was happening late in the game saw that gold was taking off, and they thought, geez, I'd love to buy gold, but I can't afford it. I'll buy silver. I think that'll happen again. But the huge difference this time is it's not going to be a U.S. phenomena with a 13% CPI. It's going to be a worldwide phenomenon due to the crash of the U.S. dollar. And so that means that there'll be so many purchases that I think will be very difficult to meet in the physical realm, that you'll see paper prices on both these metals that will be far, far higher than they are today.
Right, I know you've said that 90% of the move comes in the last 10% of the time, right?
Correct, and I did a video on that. In fact, that was my speech in Vancouver, and I forget the exact numbers. That general idea is correct. I think it was, what was it? I think it was 87.5% of the move came in the last 7% of the time or something. In other words, what I said is very accurate, that most of the move, the lion's share of the move came in the last part. And this is typical of markets now, 90% and 10. I wouldn't, go worrying about that as far as, well, David said that, and therefore it's got to be that. No, the idea is what I want to make clear. And this is true, again, of all markets. If you look at the tech wreck in the stock market back in the 2000, you'll see how far the NASDAQ went and how it accelerated at the end. So these markets tend to get very overvalued in a short period of time. So as I've said before, and it bears repeating, the easy money has been made. I mean, the guys like myself that were able to buy a silver standard at 65 cents Canadian and watch it go to 40. And then I sold mine. I showed my readers, my members, where I sold out based on, again, chart action. Regardless, a lot of these things are still up considerably from the bottom. Nonetheless, the big money is ahead of us, and the big money is difficult to capture because what happens is you get these huge accelerations, you get these vertical moves that we've already seen in silver. I mean, silver went from 19 to 48 during QE2, and I told my members, this is a warm-up. Get ready, because this is just a precursor to what's going to happen in the last blow-off rally that's going to take everybody by storm. I mean, people are not going to believe that it just keeps going up and up and up and up. But this is what takes place in all markets. But silver, even more so than gold, since it's a smaller market, tends to really challenge the emotions of people because it becomes a frenzy and it starts feeding on itself. And it will be, I think, something that will go into the financial record books.
And you mentioned before about getting into the market by dollar cost averaging. When we're starting to see a blow-off top in silver and gold, do you see that it would be good to do kind of reverse dollar cost averaging, getting out of gold and silver little by little, or will it not be a good idea even to sell your gold and silver for dollars, because what if the dollar collapses?
Right. Well said. And, something I've thought about as much as probably anyone. First of all, I'm not going to measure so much in dollars. Of course, we're looking at the charts and the sentiment, and of course, I'll get some hate mail, I'm sure. When I call a top, and those are tough, but I've done fairly well all the way up. People get so emotional, and of course, it already happened. I'll just digress a bit. When silver was going to 48, I called that top 2 days before the exact top. I got everyone out that was trading, and I trade and invest. I'm not just a trader. And I got a lot of, let's say, less than friendly emails from a few of my contemporaries that I was going to ruin my reputation, that I didn't know what I was talking about, that things were going, that silver's going to 100. I was going to, I'd never regain my reputation and on and on. And, I do my own work. And, I didn't really reply to a lot of these comments. And I said, this is the top in my view, and it turned out to be correct. And I'm not trying to do this for ego. What I'm trying to do is it's really tough to stand your ground sometimes, because some of these guys are pretty well known in the gold and silver world, and they're telling me, don't do it, don't do it. But I did it anyway. So coming back on point, I'm not interested in getting the exact top. I'm interested in knowing that silver and gold are very overvalued. And when they're very overvalued, you sell. In fact, I think it was one of the great traders that said, leave some for the next guy. In other words, if you get out within 20% of the top, you've done quite well. So it depends on the individual. I mean, some people would want to convert directly at, near the top and buy real estate, or pay off all their debt, or buy their mother a home to live in, or, whatever, to start a foundation. I mean, there's all kinds of reasons to sell. And do you sell for dollars or not? And that's, of course, a huge question. The answer is, as long as you're selling to convert immediately into another asset, and I would prefer a tangible asset unless I see things change drastically, and I don't know that until we're at the top or near the top. So you want to make a purchase of something that has real value. So you could, and there's other things you could do. You could sell direct. In other words, you could still contract in this country. Opposite to a popular belief, and you could say, I'll give you, this 1,000-ounce bar of silver for, this sector of land over here, and you could spend it into another asset doing that. So there's lots of opportunities. But again, the main thing I'll be looking for is, how much does it buy? I'm going to use a corny analogy, Elijah, and I've used it before, but it's a worn out statement that an ounce of gold buys a fine man's suit back in Rome, and it does today, suit and shoes and socks and handkerchief, umbrella, and on and on. And this is what, an ounce of gold is worth. Well, if you use that basis, and if you could buy 10 men's suits for an ounce of gold, I would suggest that gold is overvalued. And so when you see those kind of comparisons, it's time to start thinking of an exit. So you could buy a business. You could, there's lots of things you can do with it. But again, these are individual choices. I would say your idea about averaging out probably makes sense. It's really tough to know this time if we're going to see it get, I'm convinced it'll be overvalued, but how does it come back to fair value? Will it crash back down, or will it stay overvalued for a long time, or what? Most of the time markets, when they get a feeding frenzy and there's nothing but buyers at the top, then all of a sudden there's nobody left to sell to, and you get a big wash down. And that's probably going to be true again. So there's lots of strategies. I think dollar cost averaging out, I like that idea in a more steady state market, where you've bought and accumulated over time. And let's say you're, I don't know, pick a number, 65 years old, and you decide to retire, and you've accumulated X ounces of gold and Y ounces of silver. You sell, 10% of your holdings every year for the next ad infinitum, because you'll never run out in theory at 10%. So you sell, let's say, for quick math, 1,000 ounces of silver. You sell 10% the first year, which is 100 ounces. And then the next year you sell 10% of what's left, which would be 90 ounces, and on down the line. And in paper terms, as long as the market stays strong, which I think it will for years, you accumulate perhaps even more fiat the second or third year, even though you've sold less metal because the paper price is higher. So lots of strategies. I mean, I could go over others, but I think I've probably worn out the statement. But it's good to think ahead what you want. I think people fail to plan because they just get, again, wrapped up in the emotion, and then, and sometimes they don't spend it wisely, but that's not my, venue to tell them. If you want to buy on a stable of exotic cars, then so be it. But, that's not the lifestyle that I choose.
You make a lot of good points there, David, and I wanted to turn our focus now to JPMorgan's silver manipulation. I know you've talked about this a lot, and I recently heard that JPMorgan and other bullion banks are actually not short anymore, but are going long the precious metals. Have you heard about this?
Yes, I have, and the commitment of traders is probably the most favorable I've seen to 20 years. And let me spend a little time here, Elijah. First of all, there's a faction that says, well, you can't believe anything that's put out there. And certainly you have that choice. And is it possible that the commitment of traders isn't accurate? And yes, that's possible. I don't agree with that. I think the commitment of traders is accurate. But what isn't talked about very often at all is that let's assume it's accurate, and I believe that it is. But what we don't know is what the OTC positions are. We never have, and we never will. We don't know what JP Morgan's over-the-counter derivatives positions are. So they could have been net long the whole time. We don't really know. I'm not suggesting that they were. What I'm suggesting is that the over-the-counter derivatives markets that are totally private, bank-to-bank transactions, bank-to-mine transactions, bank-to-bullion bank transactions, all these derivatives that we never know who's on what side, is also a very important market, and it's far larger than what we see in the COMEX, where we can see some transparency. Having said all of that, I do think that we're probably in one of the best setups I've ever seen as far as seeing the gold and silver prices move higher. The commercials, the banks usually are on the correct side, and the speculative funds are usually on the wrong side. And it's very interesting because the spec funds got short during the breakdown. They added their positions rather significantly at $26 silver and $15.50 gold. And they were right. And they still are. In other words, you've got, they've got massive paper profits because silver and gold are both under those levels as we are doing this interview. But a transaction isn't complete until you complete it. In other words, if you sell, you got to buy back if you're short the market. And there's been not that much buying back yet. So in order for them to really lose significantly from the way it's set up, it looks to me like you'd have to see silver over the 26 level and gold over the 1550 level for these guys to lose massively. I mean, they could they could buy back in the market here, cover their shorts, and do fairly well. So this gives me a big question of like, well, what is going to happen here? It looks from all my experience that gold and silver are set up right now to move higher. But, how is it going to work? Because the funds are doing quite well right now. And the banks are basically betting that the prices are going up, not down. So that, again, feeds into the idea that the bottom is behind us. But how it all unravels is it's going to be very interesting to watch, because normally you get these moves and the shorts are caught, or I should say the spec funds are caught, and they end up losing on the trade. So we'll have to wait and see. It's fascinating. It's a position that we haven't seen this kind of a mismatch in about 20 years. I mean, it's taken 20 years probably longer in silver, to see a situation where you basically have the commercial banks favorable to the metals, not unfavorable.
Go to financeandliberty.com and subscribe for free for more interviews and financial insight.